Our next presentation deals with the rise of performance-driven merchandising. Our speakers are James Lamberti, CMO of Quri, and Lena Liu, also of Quri. Without further ado, here are James and Lena.
Thank you, John. Thanks, everyone. We're happy to be here today to talk about the rise of performance-driven merchandising, which we'll explain what that is in just a moment as we go through today's discussion. Just by way of introductions, my name is James Lamberti. I'm the CMO here over here at Quri. I have spent quite a bit of time in the CPG world, both with IRI and Clorox, as well as at a number of data and analytics startups in Silicon Valley over the years. I'm joined by Lena Liu, who's our resident expert, and we'll be doing a lot of the deep case study discussion today.
Hi, everyone. My name is Lena Liu, and I'm the Content Marketing Manager for Quri. Prior to joining Quri, I actually spent a number of years at General Mills and Kraft Heinz in a variety of sales roles, so I've definitely walked a mile in your shoes.
So thanks again for listening in. We look forward to our first lead conference with all of you. We've got about a 35-minute discussion here, and then we'll leave time for questions at the end. But the three things we want to cover is, number one, the evolution of crowdsourcing to the emergence of something called performance-driven merchandising. So we're going to talk about sort of what that evolution means and how crowdsourcing has become really something very different than when it started off 2 or 3 years ago, and has given rise to this ability and capability called performance-driven merchandising. We'll then double-click and spend a majority of our time going through 3 very specific case studies: innovative manufacturers that have adopted this platform and seen tremendous growth and results as an impact. And we'll certainly go through this discussion and make sure that we highlight some of the best practices or keys to success, so that when you leave this discussion, you go back to your offices tomorrow, you have some very specific ideas on how to make this successful for your own company. And then finally, we'll have a Q&A and any closing thoughts and discussion at the end. So as we go through and provide some context here, want to actually have you think about where your company falls on this continuum. And really this is to set the stage and provide context. Regardless of where you feel you lie on this continuum, there is obviously a huge opportunity, perhaps even better described as a necessity, to drive increased return on our field labor assets. And many of you are probably involved with or aware of the team at POI, but I think Dale's quote here sums up the opportunity we see, which is really the need to adequately support our field labor teams with the data, tools, and training necessary to convert this asset from a cost to be minimized into a strategic tool for growth. Digging a little deeper, clearly there's a lot of challenges to making that a reality, right? So if you look at this research on the far left, what we'll see is that 1 in 10 of the folks in the industry agree with the ability to decision at the store level, only 1 in 5 with the ability to execute at that level. Really, ideally, we'd like that number to be 50, 60, 80% over time. Today, it's very low. Similarly, on the far right, we believe that there are challenges with KPIs and measurement, so difficulty in showing KPIs for retail execution. And then in addition, there's a lot of issues with the process being burdensome and inefficient. And then in the middle, whether it's your third-party assets, whether it's working with retailers directly, or whether you believe you're getting the compliance you need, it's a mixed bag about the productivity and efficiency of these assets. So while the challenges are real, the opportunity is enormous. And what we're looking at here is industry data. This is actually 2 years of Quri data, 2 million store visits, where we're measuring display compliance by channel across hundreds of manufacturers. So this is one of the most substantial data sets we've ever seen in the industry. And what we see is an opportunity to obviously radically improve and increase compliance. Overall in the industry, we're at an average across all channels of about 42%. Now, we've estimated that for the industry to get even a 1-point gain in compliance is worth about $600 million to this industry, representing a 2% growth opportunity. So while the challenges are very real, the opportunity is in front of us. And certainly with performance-driven merchandising and what we're going to talk about today, we are seeing a real change in the industry and ability to actually impact and move these numbers. So last slide before I hand it to Lena to talk about Quantified Shopper View and performance-driven merchandising, we have to ask ourselves, well, why are we at 42%? And when it comes to retail execution, unlike almost every other aspect of the business at this point, we as an industry really lack the information currency needed to foster collaboration and accountability. So measurement has historically been very generic, anecdotal, maybe at a very high level in this space. Accountability has been fuzzy and opinion-based, and there has not really been a data asset that is systemically available and scaled to allow us to even look at this problem and measure it. And so really it comes down to a lack of information currency, and that is what Lena will talk about in a moment. That is changing and changing very rapidly, and that change is going to fundamentally help us improve execution.
Yeah, so with the evolution of crowdsourcing, we now have the ability to have this data asset as a data currency, which we're now calling the Quantified Shopper View. So the Quantified Shopper View is an unbiased, standardized set of in-store merchandising conditions taken from the shopper's perspective. This data asset gives us visibility to what's actually happening in store, giving us much deeper insight into execution issues and potential opportunities. And when this data is layered on top of your existing sales and inventory data, you have a much more complete picture of how your merchandising plan was executed in store and the subsequent results. And this complete picture unlocks the ability to engage in what we call performance-driven merchandising. So performance-driven merchandising is what we call a framework for doing business that really has 3 major value propositions. And the first one, which is field labor optimization, which we'll be spending the majority of our time today talking about, is ensuring that your retail labor is really in the right stores at the right time. The other 2 pillars of value are data-driven selling, which is using this data asset and this data currency to have much more strategic joint business discussions with your retailers. And then the last one is trade optimization. Like I said before, coupling this in-store merchandising conditions data with your current sales data, you have the ability to understand which one of your promotions are really the most effective at driving lift and driving profit so that you can make better decisions with your precious trade spending.
So over the next few months and in the next lead conference, we'll certainly dig deeper into the other pillars. But today, we want to double-click on field labor optimization. We've seen that with this Quantified Shopper View and with performance-driven merchandising, in the past year, I think this has been the area where we've seen the most advancement in the industry and a lot of innovation happening to try to take advantage of this opportunity. So what we're going to do today is go through 3 case studies. Each of these case studies is really a sequence, if you will, in value, starting with scorecarding and assessment. And the idea of that first case study is in the spirit of you can't improve what you can't measure. So the idea of broad-based scorecarding and measurement with a view towards systemically improving performance over time is really the first step in really successful field labor optimization. And then we'll go through 2 additional case studies that really build on that scorecarding assessment. Both are around in-cycle correction or in-store correction. One focused on display, improving display compliance, and the second home shelf location, improving home shelf out of stocks. So I'm going to hand it over to Lena, who's going to actually walk us through our first case study. And we're going to make sure to mix go-to-market. We're going to mix, we have an example from brokers, distributors, DSD. We're going to look across different channels of trade, including drug, mass, and grocery. And we're starting here with a adult bev example with distributors in grocery. Yeah, so this is taken from a real-world adult beverage company.
And like all adult beverage companies, this particular company goes to market in the U.S. through a group of non-captive wholesaler distributors. And this beer company had some market data and some anecdotal knowledge that told them that they weren't winning at retail in respect to display presence versus their key competition. So they knew that they were winning display authorizations, but they weren't seeing that reflected in store. So they put in place a program where they looked at data for their top 90 distributors, and they began to scorecard each one of their distributors on a simple set of metrics, which included their display compliance as well as their gap to their competition. And this effort was done in collaboration with their distributors. And within the first year of this rollout, they actually saw a 5 percentage point increase in their display execution. And they did that through scorecarding. So let's walk through exactly what that scorecarding looks like. So the team utilized regional and state scorecards to easily visualize which geographies were underperforming. So if we look at the left side of this slide, this is the regional scorecard that shows plain display execution for the company. And each one of these regions is looking at the same set of data so that they can understand where they might have systemic issues. And from this scorecard, we could see that the Western region was underperforming the other 3 regions. So we can then get a little bit more granular and look at display execution by state, which is that scorecard you see on the top right. And you can see that the Western states are shown in red, so they're underperforming compared to the rest of the United States. So we know that we have an issue in the Western states. So we can continue getting a little bit more granular and looking at display execution to the key competition. And so when we look at that metric by state, we find that California seems to be an outlier, as they're shown in red in that bottom right-hand scorecard there. So knowing that California has both the lowest execution and the largest gap to the competition, we know that we really need to drill down further into California. So we actually built a scorecard for the California distributors, which is what you see on the right hand of the slide here. So drilling down at the distributor level, we find that distributors I through N are really the ones that have an issue and might need an updated strategy or an approach to better focus their execution. And another way that this company did their scorecarding was they also scorecarded by individual team members. So looking at individual team members, they can find out if there are specific members that might need additional training. Also looking at it this way allows the company to set goals for their members as an incentive. And what this company ended up doing was they actually set up an incentive program for the distributors and their team members based on the scorecard and based on their display compliance.
So thanks, Lena. So I think want to pause here at the end of this case study, and you can see really what was brought to life there is systemic information currency and execution. And it is really, I think, a truth in business that when people are being measured, when we have data, it actually motivates people to perform. Like they can see their progress, they can measure themselves. It's a natural human behavior that I think is very powerful. There were some keys to success for this program that helped this particular company see a very significant jump, a 5-point jump in their overall average compliance, to the tune of about $200 million in sales increase, top-line sales increase. And the 3 things that I would ask you all to take away in terms of keys to success are, one, is the clear goal setting and alignment process. So really what this particular company did very well was pick 2 simple metrics. Obviously, one, compliance, period, and the second one was a gap to a key competitor. And using just those 2 measurements, they were able to triangulate and start to measure. The second thing they did very successfully was not only orient the distributors to what they were doing, but also the headquarter team. So now you have both internal and externally everybody aligned around what we're going to measure and what we're going to rally around. So that was key. The second thing that Lena alluded to that I want to double click on is carrots, not sticks. A lot of times a new data stream can be met with some fear. It's like, what is this? How am I being measured? And I think the key is carrots, not sticks. Make sure that people feel like there's an incentive for them to perform and they're not being hit over the head with data and threatened by it, but rather embrace it as a tool to help them succeed. And then finally, training is vital. If people don't understand what they're seeing or what this information or data is, there can be a revolution, right? And so it's really important to invest in the training of what this data is, where it comes from, and how we're going to be measured. So I want to go down to our second example, where we talk a little bit more about in-store corrections. So again, just to keep everyone oriented what we're doing here, we started with where we find and recommend people are starting, which is this scorecarding assessment. Get people trained, build a system for measurement in this critical area. The next logical step is then to start to get that data into the bloodstream of these companies so that it can be used on a routine basis to actually find and correct improvements in store. So we'll start here with a display opportunity. So I'll hand it back to Lena.
So our next example is a carbonated beverage company working with their Walmart team, their largest customer. And the business problem that this company saw is that despite having their own internal team servicing retail, they didn't have a clear picture on their display execution of key programs. So what they were getting from their retailer, from Walmart was telling them that their execution numbers were very low. And that was based on algorithms and calculations on their shelf space deliveries, and they were basically calculating whether or not something was on display, and the retailer was telling this company that their execution was very low. On the other hand, the company's internal team was using their own set of data to make their own calculations based on the retail link data going through a DSR, and that number was telling them that they were in the 90% range. So as you can see, they were getting two sets of very conflicting information, and they didn't really know which one was right. So they decided to implement a program where they collected display execution data across a large sample of their Walmart stores on a monthly basis. And what they found over a couple of months was that their display execution numbers were actually somewhere in between. So by looking at this accurate number taken from a shopper's perspective, they were able to actually visualize their true display compliance. And through that, they were able to pinpoint the specific stores where they knew that they had an execution issue and really mobilize their workforce to go in there and fix those and really capture those opportunities. And by doing that, over a 9-month period, they saw a percentage point increase in their display compliance, which translated into a $62 million opportunity. So this chart just shows you kind of the progression of their improvement. So starting in January, this company had a 27% display compliance. But by routinely measuring, they saw their display compliance increase month over month. They saw a big jump within the first month, a 9-point increase, and then they saw that steadily rise month after month. In addition, the team also did a return on investment analysis, and they found that for every additional point of display compliance, that translated into a $593,000 opportunity across all of the Walmart stores. So that they knew that every additional point of display compliance would generate additional sales. And year to date, that amounted to $62 million. Which $12.4 million of that was incremental to their plan.
Thanks, Lena. So again, I want to build on some of the best practices. We talked about goal setting and alignment in the scorecarding process, about using incentives and really motivating people to want to embrace the information, and then training them on the use. The next logical step, and the one you just heard about from Lena, was to tap into the existing process flow of information within your companies and get this scorecarding assessment in a routine basis into the hands of the people that can actually go into store and do something about it, whether it is a DSD team in this case, or as we're about to hear, a broker team. It's very important to take the time to document that process and, again, take the next step of having this information injected into that communication flow. The other point I'll make here is this is a really exciting time for the industry when you've got a new data stream like this that is fundamentally can change how we look at and perform a very key area of the business. It needs sponsorship. It needs champions. And this doesn't happen very often in business. And so what we've seen is, oftentimes senior managers, directors, people who see the opportunity, get behind it, and really champion and sponsor it throughout the organization. That is a real key to success and, frankly, a real opportunity for individuals in the industry, and one that doesn't come along very often. So we'll move into our last case study. And one housekeeping item, we are seeing questions come in. I should have mentioned at the outset that we will keep track of all questions and make sure to answer them. We generally have ample amount of time to do that. So keep those questions coming and be aware that we will answer your questions at the end of our discussion here today. So let's move on to our last example. Thanks, Lena.
Yeah, our last example, as James mentioned, we're talking about in-store corrections, and the last example we just went over with the carbonated beverage company was on display compliance and display execution. However, we can also take in-store corrections at the home shelf location as well. So this is our next example using a personal care company. And this particular personal care company was combating a potential loss of shelf space in one of their drug channel customers. So their drug channel customer was looking at a declining sales rate and coming to the conclusion that the item in question was over-inventoried and was an underperformer and wanted to reduce the shelf space of this particular item. So obviously this company didn't want to lose their shelf space, so they began to collect a routine view of their on-shelf availability. And they were looking at their on-shelf availability from a shopper's perspective, so whether or not there was actually product found in store. So that's a big difference than the numbers that the drug channel of retailer was looking at based on back-of-the-room inventory calculations and algorithms. And what they found out was that, in fact, their true on-shelf availability was much lower than what their drug retailer was telling them. So to explain kind of what that difference looks like, I'm going to explain the difference between on-shelf availability from how Quri defines it versus what the industry currently looks at. So if you look at this subset of brands, we see that the Quri observed OSA is 89%. Now this is based on just truly what shoppers see when they go into the stores. Do they actually find your product on the shelf? Versus the retailer in-stock number based on their inventory numbers and calculations is showing a 97% on-shelf availability. So as you can see, the shopper perspective and the calculations produce two very different numbers. It produces an 8% gap. And we believe that it's really important to look at it as the shopper sees it, because if a shopper goes into store and doesn't find your product on shelf, it doesn't matter if it's in the back of the room. So here we also look at, if we look at just sales and inventory data, we can see that, if you see high sales and high inventory, you often kind of just assume that you're doing well. However, once you layer on your on-shelf availability metrics, you can start to see that the situation actually looks pretty different. So, for example, if you're looking at high sales, high inventory, and high on-shelf availability, you know that you're doing pretty well and that you probably don't need to change a whole lot. However, if you're looking at high sales, high inventory, and low on-shelf availability, you know that you're really, you know that you have the potential to make up additional dollars by improving your on-shelf availability. And what happened with this particular customer was that they were actually, in this section. So they saw low sales, high inventory but low on-shelf availability. So we knew that they really had a shelving problem and that they needed to really move the inventory from the back room and place it on shelf so that they weren't losing sales. And by doing that, they were able to gain an additional facing of this particular item in order to keep up with the pace. So the result here you can see from this chart is that once they started monitoring their on-shelf availability from a shopper's perspective and not using inventory numbers, they were able to really understand which stores they had a problem with getting the product from the back room to the shelf, and they mobilized their workforce to go and close those gaps in those particular stores. And from that, they saw a very material improvement in their on-shelf availability from May all the way through August. And similar to what we saw as the opportunity, we can always tie it back to a dollar amount. For every point of increased on-shelf availability, over 92%, we saw that each point was worth $1.7 million in sales monthly over the top 80 SKUs for this particular company. So as you can see, increasing their on-shelf availability really helped them drive their top line.
Excellent. Thank you, Lena. So hopefully really bringing to life performance-driven merchandising and real case studies. These are really pretty important and exciting times, I think, for the industry when it comes to retail execution especially. This last key to success here, as you can see, is the enrollment of the retail customers. And I think this last case study really highlighted doing that. I mean, you basically had a complete disconnect between what the retailer was seeing and the actions they wanted to take for the category and what was really happening from the shopper perspective. And that previously that would have led to the wrong decision, the wrong consequence, and everyone would have lost, right? The shopper, the retailer, and the manufacturer. So what we're now finding in the spirit of information currency is the ability to align around the right view or the right measure or metric, and to have a conversation, objective conversation, partnered around it. So as we close out and head into the Q&A section, I know we've got a number of questions that have come in. I wanted to pause here and go back to the beginning of this presentation. We set it up talking about some of the POI research that essentially presented a lot of challenges and a huge opportunity from this group to actually improve retail execution. What we're really seeing from the Quantified Shopper View and from the rise of performance-driven merchandising is a pretty historic change in the industry in that this data, this in-store merchandising conditions data set, is analogous to scanner data. When I joined the industry a long time ago, I joined a company called IRI, and at the time, scanner data was just emerging in the industry. And at in my 20s, I didn't quite realize or sense the change happening. But looking back, I realized that scanner data was a massive transition in the industry. And it led to a huge step forward and leap forward with the development or adoption of category management, which didn't exist until scanner data became pervasive. We are seeing a similar change today, a seismic shift that's very exciting for the industry. And where is this all headed? The end game of this is very powerful. And what you can see here is this is actually a 2x2 grid where on the bottom you've got percent execution, and against the vertical axis, the value of a store. Every one of these dots that you're seeing is an individual, in this case, Walmart store, across hundreds and hundreds of execution and value delivery of that store. And what you're now able to do, where we're headed when we think about information currency, is to get to a strategic framework for execution. For example, knowing that in the upper right, those stores are not only very important to your business, but they also execute extremely well. You want them in your plan. You want to fight for them in your plan when you talk to your retail partners. Conversely, you've got stores that don't execute well and that may not deliver as much value. So de-emphasizing them or saving money by not including them in your coverage model or not emphasizing them in your plan is probably prudent. Similarly, when you look at this upper left quadrant, Here, these stores are very valuable, but execution's a problem. So maybe add coverage or focus on improving execution. And then finally, you've got stores that tend to execute well, but maybe aren't as valuable, so you could think about reducing coverage there, knowing that they're not as valuable, but they still are pretty good execution. So this becomes what we call a FICO score for stores, if you will, and it really gives us a vision for where we're headed. And to close out where we began, this is really about tapping into execution growth and the value of information currency, bringing it back full circle where the data asset we need for execution is now coming in line, coming into existence, allowing us to strategically plan, to optimize that plan, and then to actually execute and make changes in store, in cycle. So want to answer some questions here that we've got, and hopefully everyone was able to follow along our examples here. One of the very first ones that we've got is about how does Quri do what we do, and I guess summarizing, how has crowdsourcing evolved, right, in general? So I think stepping back a bit, just to explain where this data comes from. So there's really three parts to the process of getting this information. Step one is what we do, and what many of our competitors do, frankly, is we have a consumer or a shopper workforce, individual shoppers that are consumers like you and me that, armed with mobile technology, go into stores. They will accept $5, $10, $20 for their time in exchange for essentially collecting information and data from in-store. It's called crowdsourcing. You probably have heard about this. But in our case, we have about 500,000 consumers that on a daily basis are in about, we're in about 20,000 stores per day at this point. And we expect that to increase to 30 or 40,000 in the next 6 months per day. And what they're doing in store is simply reconnaissance. They do not touch product. That is the job of brokers, of retail teams. All they're there to do is, as shoppers, do reconnaissance. That information is then sent back to Quri and organized into software that can be accessed by manufacturers. And that data can be organized much the way you saw in this presentation, right? An individual RSM, a region, a state, a group of stores, a specific retailer, however it is that manufacturers need to consume the data, it can be organized that way because it's actually collected at a store level. And the key thing I think to keep in mind is it's near real time. This information is often 48 hours to 72 hours from when it's observed in store is in the hands of manufacturers. So the cycle and speed of this is really pretty pronounced. Now, in the last year, and going to kind of a second level of questions, in the last year, what we've really seen is an evolution that's taken place. And that evolution is what we call performance-driven merchandising, or the Quantified Shopper View, and we talked about it today. But it's really the notion that that crowdsourcing started off 2 years ago as sort of an ad hoc, I want to find out something about what's happening in store, and I'll use these platforms to go find that out. Sort of really like auditing used to be done 10 or 20 years ago. Today, because of the scale being achieved, what we've learned at Quri is that 80% of all the questions and issues that we see can be answered through a standardized set of metrics, right? And so we're now able to send our shoppers into store to collect routinely the same set of data, right? And get this into a routine, always-on data asset that allows the industry to do some of the things you heard about today. Another question was, what do the consumers get paid to take? So they get paid, in our case, cash. It is literally anywhere from $5 to $20, depending on how much time or energy it is, and that's how they're compensated. And there's a lot of again, there's a tremendous economy that's built up around this opportunity. So another question that is coming up is, how is this information different or complementary to scanner data? I'll have Lena handle that question.
Yeah, in my previous roles, I worked a lot with Nielsen and IRI data, and these in-store merchandising conditions data is inherently a different stream of data. So IRI and Nielsen, you get the back end kind of sales data. With Quri, you're getting in-store merchandising conditions data, so completely different set. We also get to a very granular level of information on in-store conditions. So for example, on your displays, we can actually tell you how many displays are found in store, what's the assortment on that display, where was the display located in store, was there any POS material found. Also, James mentioned this, the timing of our data is, in near real time. So between 24 to 48 hours, we have that. So you can kind of see that reflected very, very quickly on our dashboard. And then the other thing too is that, it is, once again, store level information. So you can really get down to a granular detail level and find out, which individual stores do you have an opportunity so that you can go and actually make those changes.
I know we're running out of time here, but one more.
Sorry, one other thing I wanted to mention about the difference between scanner and Quri data is, we see them as completely different sets of data, but also highly complementary. Yeah. I think I talked about this earlier, but when you combine the Quri data with your sales data, you can really get a complete picture of how your merchandising plan was executed and what were the results of that plan. So that can help you make better decisions going forward and really optimize your plan.
Yeah, exactly. They are very complementary and do help diagnose, especially trade optimization is key there. So I think last question we can answer, and if there's anything we didn't get a chance to answer, we will actually respond. The last question was around, let me make sure. It really was around, I think, the relationship between our relationship essentially with retailers, brokers, other people in the industry that are often responsible for execution. And I would say that's a big change too in the last year. The way I would characterize it is probably 2 years ago, retailers and brokers were neutral to negative on this concept of crowdsourcing. I think today, a couple of years later, it's neutral to positive. In the case of retailers, we have numerous retailers now actually requesting this data and starting to lean in and test a lot with how this can help them, especially with OSA. We got a really interesting question from somebody about OSA and the quote-unquote a truly effective store-level system for measurement. The retailers, some retailers are better than others, but in general, there is a gap between what the retailers are measuring as OSA and what a shopper sees. We routinely see that gap as being anywhere from 2 to 3 points to as high as 15 points. So there is an admission and an acknowledgement in the industry that measuring an algorithmic measurement based on DSR systems and inventory is not going to be as accurate as a shopper looking at the shelf. And again, like scanner data, these are complementary measures. A read on inventory is very, very important. A read on the last mile, does it get to the shelf, which is what we're talking about, is also very important. So these two data sets really work together. Last quick question about where we are located. Today we're only in the U.S., but we will be expanding internationally, of course. But we are limited today to the U.S. market with plans to expand internationally. A lot of questions coming in, which is fantastic to see. I guess we're out of time here, so I think we'll have to.
We're out of time, James. But let me just note to all the attendees: if we didn't have time to answer your specific question during the presentation, we'll get back to you via email afterwards. Okay, that was absolutely
fantastic. Thanks, everybody.
To both of you. That was really great, a lot of good information, and all the attendees will get a recording of this session to review because there was a ton of good information. Okay, and for more information, please visit Quri.com.